The U.S. government operates specialized facilities for the continuous production of physical currency. These facilities are equipped with massive, high-speed printing machines. These machines are designed for the large-scale, around-the-clock printing of banknotes. The facilities adhere to strict security protocols to prevent counterfeiting and theft. The printed currency undergoes rigorous inspection to ensure quality and authenticity. The printed currency is then distributed to banks and financial institutions nationwide. Government printing facilities produce physical currency. These facilities inject over $500 million into the U.S. economy daily. This injection is achieved through the continuous production of currency. The currency production process involves specialized machinery. The daily output significantly impacts the nation's financial system. The printed currency facilitates economic activities. The majority of money today exists as digital entries within banking systems. These digital representations are essentially numerical data stored on computer screens. Digital currency facilitates rapid and efficient financial transactions. Over $4 billion is digitally created each day, highlighting the scale of electronic finance. This digital creation reflects the modern banking system's reliance on electronic transactions. The shift to digital currency enhances the speed and volume of financial operations. Digital financial flows involve the creation and movement of money through digital systems. These flows occur across various entities, including governments and financial institutions. Global markets also play a crucial role in facilitating these digital financial transactions. The process begins with the digital creation of money, which is then circulated through these systems. This digital circulation enables rapid and efficient transfer of funds worldwide. Bartering involves the direct exchange of goods or services without using money. In ancient times, bartering was a common method of trade. A farmer requires a tool, but lacks currency for immediate payment. The farmer and toolmaker agree on a deferred payment arrangement. The farmer promises to provide food to the toolmaker at a later date. This agreement allows the farmer to acquire the needed tool and the toolmaker to receive compensation. In ancient barter systems, a farmer's promise to pay could function as a form of payment. This promise represented future value based on trust between parties. The acceptance of a promise implied confidence in the farmer's ability to deliver. This system predates formal currency, relying on mutual agreement and reputation. Ancient communities often lacked standardized currency for transactions. Instead, they relied on commonly accepted goods as a medium of exchange. These goods could include essential items like cattle, grain, or salt. The value of these goods was determined by communal agreement and necessity. In ancient community markets, certain goods were scarce. Scarcity significantly increased the value of these goods. High value enabled these goods to function as a form of payment. They could be used directly in transactions. This eliminated the need for other forms of currency. The immediate utility made them highly desirable in trade. Societies transitioned to metal coins due to their inherent advantages. Gold and silver became prominent coin materials because of their durability. The intrinsic value of these metals further supported their use as currency. This shift marked a significant step in the evolution of trade and economic systems. Metal coins served as a crucial medium for facilitating global trade in ancient times. These coins provided a standardized and portable form of currency. The use of metal coins simplified transactions between different cultures and regions. This system connected civilizations economically across vast continents. The coins enabled the exchange of goods, services, and ideas on a global scale. Metal coinage promoted economic growth and cultural exchange throughout the ancient world. Goldsmiths in 17th century London provided secure storage for gold. These vaults offered a safe alternative to keeping gold at home. Customers deposited their gold with the goldsmiths for safekeeping. In return, goldsmiths issued paper receipts as proof of ownership. These receipts represented the value of the gold held in the vault. This system laid the groundwork for modern banking practices. Goldsmiths in the 17th century provided secure vaults for storing gold and valuables. They issued paper receipts to depositors as proof of their gold holdings. These receipts gradually gained acceptance as a convenient medium of exchange. People began to trade the receipts themselves, rather than physically exchanging the gold. Goldsmiths in the 17th century acted as custodians of gold and valuables. Customers deposited gold with goldsmiths for safekeeping. receiving a receipt or note in return. Goldsmiths observed that most customers did not simultaneously reclaim their deposited gold. This realization led goldsmiths to issue more notes than the actual gold they held in their vaults. Effectively, goldsmiths began lending out notes, a precursor to modern banking practices. Goldsmiths in the 17th century began a form of banking by lending money. This lending often involved creating money that did not physically exist. Goldsmiths charged interest on these loans, generating income. This system allowed them to accumulate real wealth in exchange for essentially creating credit. A goldsmith's vault in the 17th century serves as an early model for fractional reserve banking. The goldsmith issues a loan of 100 gold coins to a borrower. Crucially, the gold itself remains in the vault. It is not physically transferred. Instead, the borrower receives paper notes representing the value of the gold, effectively creating new money. The money creation mechanism describes how new money enters into circulation within an economy. This process often begins with a single loan issued by a bank or financial institution. The initial loan amount serves as the basis for creating a larger amount of new money. As the initial loan is spent and redeposited, it facilitates further lending and expansion of the money supply. This injection of new money into the economy can stimulate economic activity and growth. Modern banks have evolved to replace traditional goldsmiths in the financial system. The contemporary banking system operates primarily with digital representations of currency. Digital numbers have largely superseded paper notes as the primary form of monetary transaction. This shift reflects the increasing digitization of financial assets and transactions. Modern banking infrastructure relies heavily on electronic systems for managing and transferring funds. The transition to digital banking enhances efficiency and accessibility in financial operations. In the digital age, personal data has increasingly become a valuable commodity. Data brokers actively engage in the buying and selling of this personal information. This commodification of data serves various purposes across different industries. The exchange of personal data raises significant privacy and ethical considerations. Marketing agencies utilize personal data extensively to implement targeted advertising. This involves flooding inboxes and screens with ads tailored to individual profiles. The goal is to directly influence consumer decisions through personalized messaging. Data collection methods include tracking online behavior and purchase history. Algorithms analyze this data to predict consumer preferences and needs. Targeted ads are then deployed to specific demographics or individuals based on these predictions. Data brokers collect and aggregate personal information from various sources. This data is often sold to companies for marketing, advertising, or other purposes. Services like Delete Me assist individuals in removing their personal information from these databases. The goal is to enhance privacy and reduce the risk of identity theft or unwanted solicitations. The total money supply was fixed before fractional reserve banking. Money only moved from person to person. The total amount of money in the economy remained constant. No new money was created or destroyed in transactions. This system contrasts with modern banking practices. A fixed money system means the total amount of money in the economy remains constant. Uneven money distribution concentrates wealth in the hands of a few. This concentration reduces the purchasing power of the majority. Reduced purchasing power slows down trade and economic activity. Limited opportunity arises as fewer individuals have the capital to invest or start businesses. Injecting money into an economy is intended to stimulate economic activity. This injection increases the availability of funds for investment and spending. Businesses can use these funds to expand their operations. Expansion may include hiring more employees or investing in new equipment. Increased business activity can lead to higher overall economic growth. The goal is to create a positive cycle of investment, production, and consumption. Economic development is spurred by the introduction of new capital. This capital enables the construction and improvement of essential infrastructure. New money also facilitates the creation of innovative products and services. These investments can lead to the emergence of entirely new industries. Therefore, capital injection is a catalyst for broad economic advancement. When a deposit is made, the bank's liabilities increase. The bank essentially creates a digital IOU to the depositor. This IOU represents the bank's obligation to return the funds. The depositor now holds a claim against the bank's assets. This system facilitates the circulation of money within the economy. When a bank provides a loan, it essentially creates a debt obligation for the borrower. This loan issuance process simultaneously generates new money within the economy. The borrower receives funds they didn't previously have access to. This injection of new funds increases the overall money supply. The bank's asset, the loan, is balanced by a new liability, the deposit in the borrower's account. Thus, lending activities directly contribute to the expansion of the monetary base. Banks have the ability to create new money when they provide loans. This process involves digitally adding funds to a borrower's account. The money being loaned is not taken from existing deposits or reserves. Instead, it is essentially created on the bank's balance sheet. This mechanism increases the overall money supply in the economy. Loan repayment involves both the principal and the interest. The principal represents the original amount of money borrowed. During repayment, the principal is returned to the lender. Upon repayment, the principal effectively exits the financial system as a loan. Interest is the additional charge for borrowing the money. The interest paid becomes the bank's profit for providing the loan service. Loans inject newly created money into the economy. This influx of capital facilitates various economic transactions. Businesses utilize loans to fund their operational activities. These funds support the production and distribution of goods and services. The flow of loan money sustains and expands supply chains within the economy. Loans are a fundamental mechanism for funding innovation across various sectors. These funds enable entrepreneurs and businesses to develop new products and services. Investment in research and development is also facilitated through loan mechanisms. Ultimately, these economic activities contribute to overall societal advancement and progress. Inflation occurs when the money supply increases at a rate faster than the real production of goods and services. This imbalance leads to an increase in the general price level across the economy. As more money chases a relatively fixed amount of goods, each unit of currency buys less. Consequently, the purchasing power of money declines, eroding its value. This sustained increase in prices is what defines the economic phenomenon of inflation. Historically, banks operated under reserve requirements. Reserve requirements mandated that banks hold a certain percentage of deposits in reserve. These reserve requirements directly limited the amount banks could lend out. This limitation was a key factor in controlling the money supply and bank solvency. Banks can access additional reserves from the central bank. This access bypasses traditional lending limits. Central banks serve as a source of reserves for commercial banks. This mechanism enhances financial system liquidity. Governments can create new money through the issuance of bonds. These bonds represent a promise to repay the borrowed money at a future date. The repayment includes an agreed-upon interest rate, compensating the bondholder. This mechanism effectively injects new currency into the economy. The government's debt increases with each newly issued bond. Government bonds are purchased by various entities to provide funds to the government. These purchasers include banks, which invest in government bonds as part of their asset management. Corporations also participate in bond purchases, utilizing them as investment instruments. Pension funds allocate portions of their portfolios to government bonds for stable returns. Foreign governments invest in bonds, contributing to the funding available to the issuing government. Governments allocate borrowed funds across diverse sectors. A portion of the budget covers public sector salaries. Significant investment is directed towards defense, including weaponry. Infrastructure projects, such as road construction, receive substantial funding. Governments often face budget deficits, spending more than they receive in tax revenue. This shortfall leads to government debt accumulation. To finance the debt, governments issue bonds. Issuing more bonds increases the overall government debt. Governments sometimes address existing debt by borrowing additional funds. This action increases the amount of money in circulation. The expansion of the money supply can have various economic effects. Increased borrowing can lead to further expansion of the money supply. The U.S. government's expenditure approached $7 trillion in the past year. This level of spending has necessitated the issuance of new debt. Debt is financed through the sale of government bonds. Bond sales are used to cover the financial gap. Modern civilization relies heavily on the concept of expanding credit. This system is based on promises of future payments rather than existing physical assets. Credit allows for immediate resource allocation with deferred financial settlement. This contrasts with a system based solely on tangible wealth, which limits immediate spending to available resources. The expansion of credit enables large-scale projects and economic activities that would otherwise be impossible. Promises within the financial system are underpinned by trust. This trust is specifically directed towards the stability of the financial system. The perceived stability of the financial system is crucial. It ensures that financial commitments are honored. Therefore, trust in the system's robustness is paramount for its functionality. Speculation bubbles arise when new capital is directed towards speculative investments. This influx of money inflates the perceived value of assets beyond their intrinsic worth. The inflated values are not based on fundamental economic factors. This creates an unsustainable bubble of artificial value. Inflationary pressure arises from an imbalance between money supply and production. Specifically, it occurs when new money is injected into the economy, primarily directed towards consumption. This influx of money increases demand for goods and services. However, if production levels do not increase proportionally to meet this heightened demand, the increased demand outstrips the available supply, leading to a rise in prices, which is inflation. War diverts resources, including money, away from productive economic activities. The influx of money into war zones often correlates with increased destruction. This destruction damages infrastructure, disrupts supply chains, and displaces populations. Consequently, war hinders long-term economic progress and development in affected regions. Investing new capital into productivity-enhancing sectors generates tangible value. Key sectors for productivity investments include education. Infrastructure development is another critical area for investment. Investment in science drives innovation and progress. Technology advancement is crucial for long-term productivity gains. These investments collectively contribute to sustainable economic growth. The mechanism that generates debt can also foster prosperity. The outcome depends on where the money is channeled. Strategic investment is key to transforming debt into prosperity. Misdirected funds can exacerbate debt and hinder economic growth. The decision of where to direct newly created money is a fundamental economic choice. This allocation significantly impacts various sectors and the overall economy. Strategic direction can stimulate growth in targeted industries. Misallocation can lead to inflation or economic imbalances. Consideration of long-term economic goals is crucial for effective allocation. The chosen path shapes the future economic landscape and societal well-being. Money functions as a representation of value, not intrinsic wealth itself. It serves as a claim or entitlement to future economic activity. This claim is fundamentally linked to future labor contributions. It also represents a stake in future production processes. Ultimately, money symbolizes a claim on future human effort and productivity. Digital interfaces are now central to modern economic activity. Each keystroke within these interfaces represents a unit of economic action. These actions collectively shape the direction of the economy. The cumulative effect of digital interactions is significant. This highlights the interconnectedness of technology and economic trends. The future economy is increasingly driven by digital interactions. The distribution of digitally created money is poised to significantly influence global economies. This influence extends beyond economics, shaping societal structures and interactions. The method of allocation will determine which sectors and individuals benefit most. Different allocation models can lead to varying levels of economic equality. Consideration must be given to the potential for both innovation and destabilization. Strategic allocation is crucial for fostering sustainable and equitable economic growth.